Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Blink Charging reported earnings after the market closed on Tuesday, and there were pretty poor results for a company that should be growing its charging network and increasing utilization there. So I want to dig into why I'm still concerned about this company and why I think the stock is worth staying away from right now. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content. And let's get right to the results. Here are the high-level numbers: $21.7 million in revenue. $16.4 million of that was product sales, that is selling chargers to buyers. And then services revenue was $4.8 million. That is when people go up and pay to charge their vehicle on a Blink charging charger. So that's more of a recurring revenue source, whereas product sales is a hardware sale. You can see that the increases here are really tremendous. 104% increase for product sales, 216% increase for services sales. That looks amazing. But I pulled up the fourth quarter 2023 numbers, and that shows a little bit different story. Remember, $16.4 million in product sales. Last quarter, $15.8 million. So only a slight increase. On the service revenue side, I think this is the one that really jumped out to me. $5.7 million in revenue a quarter ago, $4.8 million this quarter. More electric vehicles are on the market today than there were 3 months ago. In fact, this industry is growing extremely quickly. So we should see service revenue grow every single quarter. And management gave excuses like there was bad weather in California. But I just don't think a drop in revenue like that should be something that we see on the service side of things, especially at a time when we should be questioning whether Blink Charging can make a profit at all. Let's get down to some of those numbers. This is the income statement, and here you can look at the margins for product sales, hardware, and then charging services as well. Gross margin was $4.5 million in the quarter, up sharply from a year ago, but again, down from $6.5 million in gross profit last quarter. So sequentially down about $2 million. Operating expenses continue to be extremely high. $22.7 million in compensation, general administrative, 8.5, other 4.2. So $35.4 million in operating expenses on $21.7 million in revenue. That's simply unsustainable. That's a loss from operations of $30 million. If we go down to the cash flow statement, the company burned through $24.2 million in cash from operations just this most recent quarter. That's on top of $2.2 million in investments for property and equipment and other investing activities. The reason the company isn't running out of cash is that it sold $95 million in stock. So if we go back up here to the balance sheet, about $100 million in stock on the balance sheet, not much in reserve, not much in restricted cash. So given the fact that operations are burning through about $25 million per quarter, Blink Charging really only has about a year worth of runway from a cash standpoint. So given these numbers and the fact that management doesn't expect a lot of revenue growth, guidance right here is for $100 to $110 million in revenue. They're expecting gross margins to improve a little bit throughout the year to about 30%, but there's still going to be significant cash burn. Remember, those operating expenses, this isn't even enough revenue to cover just the operating expenses, much less actually the cost that goes into running the business. At the end of the day, the challenge for Blink Charging is getting to profitability and some sort of sustainable business. It's not making enough money on selling chargers to be sustainable, and its network isn't big enough or isn't generating enough profit to be sustainable either. And I have questions about whether either of those businesses are going to be good for investors long term. Remember that Blink Charging is making a charger that has a standard plug. So this should effectively be a commodity charger, and it's selling electricity to EV buyers, which is a commodity. So fundamentally, I think this is a commodity business, and this is still operating like a growth company. And I don't like that combination for investors. We haven't seen any evidence the company is going to be able to generate a profit. That's why I'm simply staying out. I think there's more dilution coming just to keep the lights on at Blink Charging. But what do you think of this quarter? Leave those comments in the comments section below. Thanks for watching, everybody. I'll see you here next time.